What happened here? Yeah, 1 minute. I've asked Akshit. Yes, what is the effective tax rate? Can you answer? Kanika, can you tell him what is the effective tax rate? Double A? No? Guy? No? Shushant?
Yes, sir.
What is the effective tax rate? No idea? Jayant? No idea? Jayant is like barely asleep. I mean, it looks like you. Okay, who will answer? Dharam? What is the effective tax rate? 1 minute. You're talking to him or you're talking to me? What is the have you understood the question?
Yes, sir.
What is, huh? What is the effective tax rate? Gaba has asked a question. Are you going to be able to answer it? No? Shivani? No? Who else? Chabra? No? Akanksha? Nobody? Yes, Sahil?
Sir, I'm not sure, but यही होता है सर.
So what is this? Speak in English. Yes.
Sir, effective tax rate is
Yes.
sir, compounded rate. Sir, in 1 year.
It's an average tax rate.
Sir, 1 साल 1 year.
No, 1 minute. Yeah, go ahead.
Sir, we have number of periods in 1 year. Like we are compounding every month. But for effective tax rate, we calculate that what will be the actual amount.
No, first tell me, effective tax rate is going to be expressed as what? An absolute number or what? A definite integral or a definite differentiated figure? What is it going to be? How is it going to be? What is the effective tax rate? How does it? 1 minute.
Sir,
What is it going to be expressed as? 1 minute. 1 minute. Water is measured in how much? Bring me like 5 liters of water. So water is measured in liters. So effective tax rate is likely to be given what kind of unit? Is it a, somebody said percentage, right? So first 1 minute. Yes, be quiet please.
If I am earning 1 lakh and
Yes.
I am paying tax 25,000.
Yeah.
So if I divide 25,000 by 1 lakh, that is effective.
Yeah, so that is what it is, okay? So you have to wait 1 minute. 1 minute. Be quiet. So 1 minute. So the effective tax rate is the tax liability accrued for a particular period, okay? Divided by the taxable income for that period.
Yes,
That's what it is, okay? So effective tax rate is normally distinguished with respect to the marginal tax rate, which is the tax rate that you pay on the highest levels of your income,
Yes.
okay? So effective tax rate is likely to be lower or higher than the marginal tax rate? Lower. It will always be lower than the marginal tax rate. Yes, speak in English. What is the problem?
Sir, it is very difficult, sir.
And given the mic and speak in English. Yes. Yes.
Sir, like we are compounding every month. Sir, but we have to take out the effective tax rate for a year. Then effective tax rate will be more than the compounded tax rate for that particular.
No, normally when we calculate effective tax rate, we are not really trying to factor in time value of money. We normally effective tax rate is always with reference to a particular financial year or an assessment year, okay? So we normally talk about it as an annual figure because in every country tax is taken on an annual income, okay? So the effective tax, when we discuss effective tax rates, we are talking about an annual figure. Total annual tax liability accrued and total annual taxable income for that period. Okay, the reason I say accrued not paid is sometimes because of other kinds of concessions and other adjustments, you may not pay in that particular year. Okay, so that's what it means. Okay, so is this clear? Effective tax rate. Okay, all right. So Dharam will lose some points because he's talking. So we have the first 1 minute. 1 minute. I don't know why you guys are. If I hear anybody clapping now, then they will also lose points. Okay, where is Dharam's team is at the end. So TJ has also opened his account. All right. Right, so a few other points. Let me say here we are not getting this, I'm not able to get the comparison. I was telling you, if you remember some time ago, I was telling you about coordinated when we were discussing hedge funds and somebody was discussing, we were discussing high water marks.
Yes, sir.
And you were saying, you were talking about where situation is that you won't be earning any money
Yes.
if you have a large drop in the assets, okay, in your performance. If you have a large drop, that you won't be earning any money. So we just got this news that, so if you actually see, unfortunately this link is not working for some reason, comparison link. If you actually superimpose, I was talking to you about the coordinated fall in the oil price and the stock market. Okay, if you look at this is like 4 hours. This is, I don't know, this is actually 1 hour. So if you take 4 hours, you'll see then I was able to plot this together. For some reason now this link is not working. This is the S&P 500 proxied by this SPY ETF. So you actually see that there's like the oil price kind of peaks just here and the equity market peaks here, and the sharp drop in the oil price is almost perfectly coordinated if you are able to actually get this chart up and somehow this link is working. So there are sometimes you will notice in the markets that there are very coordinated moves in different asset classes. So here you can see equities and oil prices actually almost moving together. But what you have to look out for when you see that kind of correlation is make sure that the
dependency of because US being an oil exporter, so sir there is a loss to US if the oil prices decreases.
okay, it's a good way of trying to figure it out, but I mean, so in that sense it's good, but I will also caution you against trying to get too caught up in these logical explanations, because one of the things you'll find is that the market is not really perfect. It doesn't really work in a very logical way. So you should also not have that wrong impression in your head.
So
That the market will function logically.
Can be one of the
Yeah, but it's good. As I said, it's a good way to try and explain it, because most of the people in the market are trying to explain it. But also, you should be also aware of the fact that the market doesn't really work in a. You should have that awareness also in your head, because so that you don't get very caught up in this narrative. Okay, so that's what happens. But what you have to look out for is. You understand correlation. There is a directional correlation.
Yes.
Okay, in the sense that when oil prices drop, the stock prices also drop.
Yes.
Okay, that's the directional correlation, but you also have to look at the magnitude of the correlation. Okay, like maybe that oil prices, so you have to be careful about the two different, they're two different things. So maybe that oil prices are dropping much more, whereas equity prices are dropping much less. Okay, so that's another aspect of it. One is the directional movement, okay, correlation in the directional movement, and the second is the correlation in the magnitude of the movement. Okay, and the third thing you have to be aware of in all these correlations is, because you will find when you go into the industry, you will find that a lot of people will be very, they get very caught up in this, correlation between different asset classes. Like you have a correlation between VIX,
sir, gold and equity.
gold and equities and all kinds of things. So that people get very caught up in that stuff. Now what has happened, Tushar also, I'll have to have deduct marks. Tushar is very active trying to distract Mansi. And okay, where is Tushar?
तनुज के साथ बैठे
Where is Tushar? Okay, Achal. So Achal, your team is outperforming. Okay. All right. So what was I saying here? Let me go back to that. Okay. So the thing you have to be careful about is that while I just showed you, I mean, I was not able to show you because we can't get, I'm telling you that there was correlation in this movement, okay, in the peaking of the oil price and the stock index, and the sharp fall in the oil price, especially after that, okay. So after this period, from this period onwards, there's pretty close correlation in the directional movement. So watch out for the difference in the directional correlation and the magnitude of the price movement, how correlated those magnitudes are. And the third thing to watch out for in all this correlation is that many people will get caught up in, like he was saying, gold and equities and things like that. Okay, all kinds of things people get caught up in. Be very careful, because these correlations are not stable. Okay, they're not stable in the sense like you can have stable correlation if there's like, if you assume that, it actually affects, actually snowfall in Simla affects rainfall in Delhi. Okay, that kind of correlation is likely to be much more stable because it's a physical phenomenon. Okay, but these market correlations are not very stable, so be careful. Keep that also in the back of your mind, because people in the market might get carried away by, wow, look at this correlation between gold and equities, so therefore if we feel that gold is going up, something else will happen to equities. So be aware of the fact that these correlations are not stable. They can suddenly change. Okay, suddenly the correlation will break. So this is basically what makes, I mean, this is all part of the phenomenon. I mean, this is what makes markets very difficult to predict, because these are not stable systems. There's no real rule. Like you saw what happened to Amazon the other day. Amazon came out with record profits. Amazon earnings came out. Okay, all these big companies, when they announce earnings, you should follow them. Facebook, Amazon, these are big global companies. Google, these are big global companies. So when these companies come out, Unilever, you should actually listen to the earnings call, listen to the earnings releases, the discussion of the earnings, because you get a very good picture of what's happening around the world. But you notice what happened to Amazon, the stock price actually fell, even though they announced record profits. Okay, the stock price actually fell, because the market is saying that the guidance is not positive, because the forward guidance is not very encouraging. The market was expecting Amazon to be much more bullish about the future, but the outlook that they gave for the future quarters, that outlook was not positive. Even the profits are record profits, beat expectations. Okay, but
So what do you mean by forward guidance?
guidance means when a company is announcing earnings, they will also give some kind of guidance about what's likely to happen in the upcoming quarters.
Growth rate.
Okay, what they're just giving some kind of impression about what they expect.
Predictions.
Yeah, predictions about what they expect in the upcoming quarters. So that guidance, what the market was expecting, that guidance fell short of market's expectations. But the actual profit numbers they've beat expectations. Okay, so in spite of that, the stock price falls. Now the problem is, I'm just going to give you I'm going to give you various examples of why markets are so difficult to predict. Now, how are you supposed to know that for this particular quarter's earnings release, the market is going to choose to focus on the forward guidance rather than the actual profit numbers? Because in other quarters, you're going to see that the actual profit number is very good and then the market goes up. The stock price goes up. Are you following what I'm saying?
Yes.
So the market, what I'm trying to show you is that the market is very whimsical. In one particular quarter, the market reaction. Okay, so in one particular quarter, the market may choose to focus on actual profits being higher than expectations, and based on that, they will buy the stock after the earnings. Yeah, so and then in some particular quarter, you will find that they are actually not focusing on the actual earnings, whether they beat expectations, they are focusing on the forward guidance. Are you following what I'm saying?
Yes.
So in just looking at market reaction to a particular stock, okay, when they release earnings, you'll find that the market focuses on different things at different times. They give differing weights to different factors at different times, and there's no way to tell what they're going to do next. Okay, so there are some.
Same happened with the Google.
Yeah, could have happened to Google also.
The market were expecting it to be bullish, but it went bearish because the workers of the Google doubted the Sundar Pichai's visions.
Okay, I haven't followed that story, but yeah, if you said. So basically, you don't know what the point is basically, you don't know what the market is going to focus on next. Okay, so the market is very whimsical, so you have to be aware of all these problems.
So is there any correlation between divorce of Jeff Bezos and the profits of the company? Like people have to buy
No, this is actually not a very frivolous question. There are some people who are asking this question. So the question is only relevant to the extent that you think that his wife Mackenzie is going to, when she gets that 60 billion worth of stock. Now, is she going to be a disruptive shareholder? Is she going to come and start interfering with the operations of the company, or is she going to be a passive shareholder? She could also be a passive shareholder. She might decide that
she can sell all the shares and get
she could sell all the shares, or if she sells, of course, that's not a factor. But if she sells, of course, they will lead to some dilution in control. Okay, some other people might come in. Or if she just sits on it and she's a passive shareholder, if she believes that Jeff Bezos is doing a great job managing the company, why mess with it? She might just be a passive shareholder and just enjoy the dividends. Okay, so it all depends. But it's not a completely frivolous question. People were asking this question, like what's going to happen to the management of the company? Okay, so yeah, so these are just the point I want to emphasize is, one is that you will sometimes see correlations, moves, and many of the hedge funds might close because there's a coordinated decline in many asset classes, and then of course also be aware that correlations are not stable. All right, now one more thing, if you see here, there's this sharp fall in the last part of 2019. You'll see that there's a story actually, which is the Japanese investment fund, which is the world's biggest pension fund, GPIF. Have you heard of GPIF?
No, sir.
Okay, so this is a government pension investment fund. These are their returns. Okay, the Japanese is the world's largest pension fund. So you can see their negative returns in the last quarter. This is mainly due to the equity drop in equity prices. You see this large drop in equity prices last part of 2019. So this also hammered the Japanese investment fund, because before this they had moved into equities. So this is also something that you should be aware of, that the world's largest pension fund is the Japanese investment fund, the government pension investment fund. Okay, so they've suffered. You can see the reaction in a particular fund's returns. When the market falls like this, you can see a sharp loss in their particular quarterly return for the last quarter of last year.
The fund invested in S&P stocks.
No, they invested, even the Japanese stocks fell. So there was a coordinated decline in stocks around the world, and they have stocks diversified. They have some amount in US equities also. You can see the split here. Okay, you can read this. I'll put this article in your notes. So you can see here, this is the split of the Japanese investment fund. You can see they're largely operating as a traditional fund manager, just investing in stocks and bonds, but they're now looking to invest a little bit in hedge funds and private equity and other stuff. But you can see this, they have some foreign bonds and foreign stocks, and domestic bonds and domestic stocks. Okay, so that's just an example. Okay, so let's get on with what we were doing. I think there's nothing else. Okay, one more point on your what's going to happen on your project. After this class, I didn't want to send the mail before this, so I will send a mail to some people. Okay, do you guys need more than 3 accounts per team?
No.
3 accounts is enough? Okay, so the same rules apply. So one account, don't do anything in one account, practice with the other 2 accounts. So we'll have to reset these accounts. All right, so I'm going to send emails to 3 people from every team, and you will get a mail from Interactive Brokers, just like the mail you received earlier. Set up a new set of accounts, so forget the old accounts, but please make sure you keep track of your password. Okay, and then the team leader should aggregate the 3 passwords and immediately email it to me. 3 IDs. Is everyone clear about this? Say Ayushi will get a mail. Ayushi will get a mail. 2 of the other team members in her group will get a mail. Essentially, it just goes to the people listed in CP in that serial order. First 3 names in the CP list. Okay. So 3 people from Ayushi's team, 3 people from Achal's team. Every team, 3 people will get a mail. So you set up your accounts. Okay, and then the team leader. Please don't forget, because last time a lot of people did not send me their emails, their IDs, like your team didn't send. Okay. When you set up your IDs, what happened? You're looking like you're not following what I'm saying. Yeah. So you will get that email from Interactive Brokers. Set up the account ID, the username, and the password. They'll give you a password. Please make sure you note down the password carefully, because once it's lost, it can't be retrieved. Okay. So make sure you note down the password, and then once you do that, once the 3 of you have set up those accounts, then the team leader should send me a consolidated email with those 3 usernames and 3 passwords. Like Sinha, what you did last time was you sent me just names saying Vaibhav Sinha, Achal Singhal. I don't want names. That's what you did last time. I don't want names of people. I want Vaibhav 1, 2, 3, 4 or something. That's going to be your ID and then your password. Is this clear? Okay. So is everyone clear about the instructions?
Yes, sir.
Okay. So let's do that again, and hopefully we can set everything up and we have the live data going, and then we can get started with the project practice, and then I'll get into the project brief quickly. Okay, so let's try and finish up what we have from before. Okay, so we were doing this, we were discussing debt capital markets, how bonds are issued in capital markets and how they're priced. In this discussion was happening in the context of the government treasury. Okay, why were we discussing the government treasury? Okay, surveying the financial sector, all these. We have covered all of these. Then we came down to the government treasury. I've given you a link to the US Treasury webpage. Okay, so you can learn a lot from here. So again, these are all reliable sources. The US Treasury webpage, whatever you read here is good stuff. Okay, if you go to the US Federal Reserve webpage, so instead of surfing around on the internet and looking at all kinds of dubious sources, these are the kinds of sources which are reliable. Okay, so government treasury, since the government issues only debt and not equity, so we are using this as an opportunity to learn about issuance and debt capital markets and how trading occurs in debt capital markets. All right. Okay, so Dharam, please keep a track on how many people are going out. Okay. All right. So what's Namita, tell us what is going to happen? How do we, if Airtel has issued bonds for 5 years at an interest rate of say 12%, what are the 2 components of that corporate bond yield? Is my question clear? Say you've been told that Airtel has issued bonds, okay, for 5 years, and the bonds have been issued at a YTM of 12%. Okay, So what are the two components of that corporate bond yield? Quiet please. Components in the sense if you're drinking a cup of coffee, the components of that cup of coffee, there's sugar, there's milk. That's how the coffee is made. So in this case, when you look at that yield of YTM of 12%, it consists of what components or how many components and what are they? Is everyone clear about my question?
Yes, sir.
Yes, Namita, can you help us? Is the question clear?
First is time period.
No, that's not my question. No, not clear. Nikita? Not clear. The question is not clear or you don't know the answer? Question not clear. So if you see a let me just make it theoretical, just not giving an example. What are the components of what are the components that constitute the corporate bond yield? This is called the all-in yield, okay? All-in means, all-in means all put together, okay? All-in corporate bond yield, what are the components of the corporate bond yield? What are the components that constitute the corporate bond yield? Any idea? Sonam? What are the components of the corporate bond yield? No, why don't you come and sit here? Come to the first bench. Okay, who's going to answer? Who's got the mic? Yes, okay. Tell us what are the components of the corporate bond yield? This is just recap from the last class. 1 minute.
This is the credit rating of Airtel.
Credit rating?
The credit rating जो भी है वो.
No, whatever, what do we call it?
Credit
The
spread.
credit नहीं credit नहीं.
Okay, so it's a credit spread. Okay, and what else?
अच्छा और दूसरा सा free rate जो होता है.
Why are you continuing to speak in Hindi? Are you trying to make a point?
It is very difficult.
No. This is at a business school. I have no problem with Hindi, but in a business school we should be speaking in English because many of you don't speak English very well. Yeah. Okay, you guys are coming in. You guys are all absent.
Okay, sir.
Okay.
So
No, if Ashok sir sends a mail, I'll give you guys attendance.
Sir, we can show you the mail.
No, not that kind of mail. I mean a post facto mail. Okay, Sonam, come to the front bench. Now Saksham can also sit here. Come here, come to the front bench. Okay, so credit spread. One is credit spread. What else?
The other is the risk-free rate.
What is the problem? Why is there so much noise? What is the other one?
Risk-free rate.
Yeah. So the right way to express this is to say that the components of the corporate bond yield are the credit spread, the corporate credit spread, and the benchmark government bond yield. Okay. So let's call it the benchmark government bond yield, but this is actually the benchmark. I don't want to. If I write this here, okay. Let me just. All right, so get benchmark government bond yield plus the credit spread, okay? All right, so this can also be the cost of debt for other sovereigns also, okay? So for instance, if you have, let's say, the Kingdom of Denmark issuing bonds in US dollars, okay? So they will also be priced in the same way. So there's going to be, if you're going to be pricing if you're issuing US dollar debt, then you are going to be using the US sovereign as the benchmark, okay? So if you are using yen bonds, if you are using issuing debt in yen, then the Japanese government bonds will be used as benchmarks, okay? So in this case, Kingdom of Denmark, so that's why I said cost of debt for corporates or other sovereigns issuing so for instance, the US dollar is the most popular currency in the global in the debt capital markets, okay? So you'll see many sovereigns, non-US sovereigns issuing debt in US dollars, like Kingdom of Saudi Arabia, Kingdom of Denmark, okay? You have Venezuelan bonds trading right now, which are actually not trading because they've been affected by US sanctions, okay? Remember what kind of, so you have Venezuelan bonds issued by the Venezuelan oil company, okay? I think there are some sovereign bonds as well, which are now not trading anymore because people are not trading those because the US government has issued sanctions, okay, on the trading of Venezuelan because they're trying to enforce regime change in Venezuela. They're trying to kick out this Maduro guy and bring in this other guy, the Guaido, Juan Guaido, I think his name is. So they have actually issued a directive saying that no US based entity should trade in US government bonds. There's actually a story on that on Zero Hedge. When I give you this link, you can follow this website. This is also a very good website to follow. They have a lot of political reporting, but in between that, they have a lot of interesting markets reporting as well. Okay, so like you see the story on the Japanese investment fund, the government, the GPIF. Then there's a story on the Venezuelan bonds. Okay, so what kind of risk is this? Remember, we followed. Are you following the story that I'm telling you?
Yes, sir.
So there's this company called PDVSA, which is the petroleum company, the national petroleum company of Venezuela. Okay. So PDVSA has issued some US dollar bonds, okay, and there are some, maybe we can actually just look at the story here, and maybe that story is still there. There was a story on the Venezuelan bonds. It may still be there. Venezuelan bonds. Maybe that's gone to the next page. Okay, but anyway, so what has happened is they've issued, this is the one I was talking about. Okay, so trading in Venezuelan bonds has frozen, so this might be the sovereign bonds as well, but there are definitely includes bonds of PDVSA. So what kind of risk is this? Economic risk. We discussed 5 types of risk.
Political, financial.
What kind of risk is this? You've forgotten the taxonomy of risks? Legal and regulatory. Okay, so this is actually regulatory risk. Okay?
But economic circumstances has led to this legal risk.
No, that's a very broad category. That's why I remember when you raised this point when we were discussing the taxonomy of risk, the reason we don't use economic risks is this is a very broad category, and that there's not much you can do in terms of managing those kinds of risks, those broad risks. That's why we talk about market risk, credit risk. These are narrower categories which are easier to focus you on, you can focus on those and actually try to manage those. Okay, so this is regulatory risk. There's nothing much you can do once the US government, what has happened is, here I think there's some, here, look at this. The US OFAC, this is the Office of Foreign Assets Control, very powerful. Remember, US sanctions are very powerful, okay? So if they can actually literally cripple a country. So in fact, the US has been very restrained. The Chinese, for instance, there's a lot of trade war. If the US issues basically decides to kick China out of the US dollar system, the US basically can decide to kick any country out of the US dollar payment system. Okay, if it does that, that country is basically finished. Okay, international trade cannot happen without US dollars. So all this trade, all this talk you hear about yuan replacing the US dollar, this is all very premature. So effectively, the US actually has been very restrained on China. If they decide, they can just kick China out of the global financial, US dollar-based financial system, and the Chinese economy will just freeze up, because no country in the world can survive without US dollar payments. That's what they're trying to do to the Iranians. Even now, they're still restrained on the Iranians. He hasn't gone full tilt on the Iranians as even now.
Sir, if there is, if US ban China using US dollar, so there is a loss to US also because the demand of the US dollar would decline.
Not really, because everybody has demand for US dollar. Every country, if you look at it, these are all myths. In our country, especially, people have a perception that there's an elevated perception of Chinese economic prowess, and there's a depressed perception of US economic power. If you look at it, the world's most liquid capital markets are in the US. All the countries with massive trade surpluses like Singapore, South Korea, all these countries, where do they invest their surplus funds? Everything goes into US debt cap, US treasuries. There's no other market in the world that comes anywhere, not even the UK gilt market or the Australian bond market. Nothing comes close in terms of depth of the market, liquidity of the market, the size of the market. Nothing comes close. That is why they wield so much economic power. And actually, Trump has not really been using it. I mean, if he really wanted to be nasty, he could really create a lot of problems for these people. He's being very, very restrained. Actually, what I notice is that he's being very restrained in terms, given the amount of power these guys, they can literally kick a country out of the US dollar payment system. They can just say no US dollar payments with this country, and this country will just freeze up, which is what is happening to Venezuela. Okay, so you see this directive comes, though this, as Bell has pointed out correctly, this is an example of regulatory risk. So all these poor guys who were holding Venezuelan bonds, okay, so this is obviously bonds issued by, okay, they stopped trading sovereign bonds also. Can you see this?
Yes,
this is PDVSA, this is their ticker symbol. You should know the names of these companies also, okay, because Venezuela is has the world's largest proven reserves of crude oil, bigger than Saudi. Okay, so and look at the state of this country through economic mismanagement. So they're both sovereign bonds and PDVSA bonds have been now frozen. Just imagine you're a guy's investor holding these bonds, and suddenly you get this regulatory directive from the OFAC, and that's it. You can't trade in those bonds anymore. So you're just sitting there. Now whatever happens to the bonds?
Value zero.
Value not zero. You see the plot here? You see the plot here? Value is cents on the dollar. Normally when we talk about distressed debt, we talk about distressed debt as cents on the dollar. Okay, so you can see here it goes down to 20 cents on the dollar in December, okay, of 2017. It goes down to 20 cents on the dollar. Now it's back to about 35 cents a dollar. Okay, so this is typically how distressed debt trades. Okay, so these companies like Oak Tree and all, what are they going to do? Okay, if they have a division specializing in sovereign debt, okay, they will go in and sweep if they feel that Venezuelan debt actually is going to eventually get repaid. Okay, they will go in and buy at these kind of levels. This is what they do. This is what distressed debt investing is all about. They will wait for a market panic, wait for prices to drop to this level. If they feel that eventually this debt will pay off, because this debt is maturing when? 2027. Okay, so if they will take a call on Venezuela, they will see what's going to, if they take a view that Venezuela will eventually be able to pay these bonds, pay off these bonds, they'll go in and sweep in and buy, okay, buy these bonds and wait for it to eventually pay out. Okay, this is what distressed debt investing is all about. All right, so you can survey this article, this news source as well. You get some interesting stories. You can see here in today's articles as well itself. Okay, so we looked at ratings. Right, now what do we do? So we have, when we look at a corporate bond yield, we know that there are two components: the corporate credit spread and the benchmark government bond yield. Okay, now can we decompose the government bond yield further? When we look at the government bond yield component of it, okay, so corporate bond yield, all-in corporate bond yield, we have split up into two parts: corporate credit spread and the government and the benchmark government bond yield. Okay, benchmark sovereign yield. Now, can we focus on the government bond yield, the benchmark government, and split it into two parts or three parts or whatever? What are the two parts?
So today's rate and the
1 minute, one by one. Yes, give the mic to Arihant.
So one is inflation.
What inflation? Be specific. Give him the mic. So you are now decomposing the benchmark government bond yield in any given currency. Okay, what are going to be the two components or three components or whatever?
First is the risk-free rate of interest,
Okay.
RF, that we refer to, and the second one is the inflation that the economy will have.
No, 1 minute. So you are saying that normally when we say, when Goel was mentioning he was talking about the components of the corporate bond yield, he mentioned that the risk-free rate will be one of the components. So that was taken as the government bond yield. So now you're saying that the government bond yield, when it's going to be further decomposed, one of the components will be the risk-free rate. So what is the government bond yield in the first place? Is that not the risk-free rate? Are you following why I'm confused? Okay, and your second point was about inflation. So this is, are we talking historical inflation or what?
The expected inflation.
Expected inflation. So one component is going to be, so now when you're looking at, so it's a simple question. If the US government approaches you and asks you to invest in their debt securities for 10 years, okay, what is the process that you will go through in arriving at your answer? Suppose the US Treasury asks you that we want to borrow money from you for 10 years. What interest rate do you want us to pay? Okay, so you will give them an answer X%. So that X%, how will you arrive at that X%? That's what we are talking about here. Is the question clear?
Yes.
Okay, so one of the answers is what Arihant has given. One of the components is you will factor in what is going to be the expected inflation in the US economy over the next 10 years, right? So suppose that's say 3%, if you assume that inflation is 3%. Now, is it sufficient for you to just get 3% from the US Treasury? No, you want something more. So what is that something more that you want? Today's
Sir, repo rate we can say.
repo rate? Have you heard of the difference between real rates and nominal rates?
Yes, sir.
You've heard of the Fisher equation and all that?
Yes, sir.
You've done all that?
Yes, sir.
In which subject did you do it? In economics? Okay. So, okay. So, the real rate and nominal rate. Okay. So, what is the real rate?
So nominal rate less divided by inflation.
No, 1 minute, let him finish. Nominal rate, your initial track was correct. Nominal rate less expected inflation, right? So the nominal rate, okay, let's do this here. So let's do some, so the real rate, we're all talking about interest rates here. So real rate equals nominal rate minus expected. Do you agree? Nominal rate minus expected inflation. Is this clear? Everyone agrees? Okay. So if the real rate is nominal rate minus expected inflation, then can we write, how do we write the nominal rate?
Nominal rate is on real rate plus expected inflation.
Okay. Right? So we are going to write the nominal rate. So instead of using maths, we are just writing in English. So nominal rate is equal to real rate plus okay, is everyone happy? Who is not happy? Okay, let's bring this here. Is this clear now?
Yes, sir.
So real rate is equal to nominal rate minus expected inflation. So the nominal rate is equal to real rate plus expected inflation. So the government bond yield that you use as a benchmark when you are talking about the corporate bond yield is being composed of the credit spread plus the benchmark government bond yield. Is that a nominal yield or a real yield? That's a nominal yield. Okay. So therefore that nominal yield now when you're decomposing the nominal government bond yield, when you're decomposing the nominal government bond yield, and we have already clarified that Aryan's one part of his answer is correct, that one of the components of the nominal government bond yield is the expected inflation. Okay. So therefore what is the other component?
The rating. Tax
Real rate.
Real rate. Okay. So are you getting the answer now?
Yes, sir.
So when the US Treasury approaches you and asks you that we want to borrow money from you for 10 years, what rate do you expect? What rate would you like us to pay you? What YTM are you expecting as an investor? Okay. So what is the process that you have to go through in arriving at your answer of X%? What you are going to do? What are you going to do? Tell us the process, Tanuj. Is my question clear? Because you're not listening. So when the US Treasury approaches you and asks you, if we want to borrow money from you for 10 years, tell us what YTM are you expecting? Okay, so when you give them your answer, X%, what process do you go through in arriving at that X%?
Target real rate plus
Yeah. Okay. So target, what you do is you figure out what is the target real rate of return that you expect over the period. Okay.
Yes, sir.
So different investors can have different expectations on the target real rate, but you would have some idea in your mind that this is the real rate of return I would like to achieve over 10 years. If I'm lending to obviously this is lending to a sovereign because there's not going to be any credit spread component here. Okay. Because you're pricing the government bond.
So if we are lending to suppose US government, so
Yes.
there would be less credit spread as compared to if we are lending to Bangladesh government.
No, that's basically here what you're saying is in general what we assume is that when you're looking at local currency debt for sovereigns, we don't add the credit spread is zero essentially. For local currency debt, local currency sovereign debt, okay, in a fiat currency regime, okay, we assume that the risk is zero, although there is a very important exception to this, which is the Russian default. Have you guys heard of the Russian default? of 1997-98, which led to the US with the Asian financial crisis. I mean, it basically was very shortly followed by. Okay, we're going to deduct some marks for Nagpal and Mittal, who are involved in their own little game. I don't know what game they're playing, but where is that? So, are they in the same team? Okay, so Rahul has a few more points, and whose team is sorry, where are we? Am I going in the right direction? Akanksha. Okay, so Akanksha has opened her account. Okay, I'm surprised that Ayush's team is scoring for the first time now in the fourth session. Normally Ayush is quite a prolific scorer, but he has still not opened his account. Okay, all right. Okay, what was I talking about? So the general assumption is that, let's put this here, okay, that assumption which is that local currency, I'm not going to worry about spelling, okay, sovereign debt in a, you know what a fiat currency regime is?
Use of multiple currency.
No. Fiat currency regime means, you know what a fiat is?
Notes and currencies.
Hmm?
The notes and currencies that were issued by government.
Yeah, so fiat currency, fiat is basically a direction, a directive, okay, an order, okay. Here we don't mean fiat as in Fiat, Lamborghini and Porsche and that. We mean fiat. By fiat means an order or a directive, okay. So fiat currency, these rupee notes that we use in India, they have no value. They only have value because the Reserve Bank of India says that I owe 10 rupees to the holder of this paper, right? So this is basically money is being created by the fiat of the government or the central bank, okay, which is basically a part of the executive branch of the government, okay, effectively. So are you following what is meant by a fiat currency regime? What? People are still not, I think the response is not convincing.
So everyone is trying
Yes,
to
That's okay, but you make an effort. You're young people, you should have more energy than this, okay?
eaten for the last 4 hours.
So who's stopping you from eating? Eat anything. There's no ban on eating in my class. There's only a ban on talking.
You can do anything without disturbing anybody.
You can eat. So if anybody has any food, please give him some food. Okay, guys. Yes, Mittal, what is the problem? You are not talking, but you are engaged in some activity which is distracting to me. So if you eat means you have to eat on your own. You should not be, there should not be any communication with anybody else. Okay? You should be an island. Okay. So fiat currency, has everyone understood? Yes. Everyone is there half asleep. So fiat currency means this. Most of the modern economies today have fiat currency. Only in Singapore there is some kind of a loose gold standard that works. Okay, but most of the countries, US, Canada, India, okay, UK, everything is basically all fiat currency. The money is good only because the central bank says that I will pay you 100 rupees, okay, to the bearer of this note, okay. So that's a fiat currency regime. So the reason we say that in a local currency sovereign debt in a fiat currency regime is considered to be risk-free is because obviously the government can just easily print that money and pay you back. Okay, so that's not a concern. Okay, so there is obviously in a fiat currency regime, and the exception is the Russian default. Exception is the Russian default because Russian default was on their ruble bonds in, I think this is 1997 or 98. I think we can check that, but it's 97, 98 essentially. There was a big Russian default. Ruble is the Russian ruble. I might have spelled it. I think it's the right spelling. Yeah, ruble is the Russian ruble is the currency. Okay, all right. So this is local currency. So there's a case where the very high-profile case where this assumption did not hold. The Russian government had issued a lot of bonds in rubles. Okay, local currency debt for the Russian government. The Russians could have just printed more rubles, and they also had a fiat currency regime. The central bank could have just printed more rubles, but they chose to default on the debt. Okay, so this is an exception to this rule, but in general we assume that, coming back to your point, we assume that sovereign debt, local currency sovereign debt, is risk free. Okay, all right. So therefore, so the government bond yield is consists of. So when you're trying to figure out this rate that you're going to quote to the U.S. government treasury, when they ask you as to what YTM do you expect if we want to borrow money for you from you for 10 years, what you will go through in your mind is the first question is, what real rate of return do I expect over 10 years? Okay, suppose that's 4%. Okay, and then you will make a projection about what do I expect inflation to be over the next 10 years. So suppose that's 3%. So then you will quote a YTM of 7%. 4% plus 3%. Is this clear? Okay. All right. Okay. So we are doing so. Therefore, to sum up now, if we want to split the corporate bond yield, the all-in corporate bond yield, into three parts, what will be the three components?
Real rate, plus expected rate of inflation, plus
Credit spread. Okay. So I understand that everybody is tired, but you have to be a little bit less sloppy. So you have to say target real rate of return. Okay, what is my target real rate of return? Are you following this? Does this make sense? So we are calling it TROR, target real rate of return.
How target real rate of return is determined?
That is something that is a subjective exercise. Okay, it may be different for different investors. Okay, so there is a way to figure out which is to look at the market's expectation. I think we should mention this. So these are the three components. Okay, so I've given you guys, all of you would be well served in reading this wiki, going through this wiki. There's a lot to learn from the Treasurer's Handbook. You can learn a lot about corporate treasury risk management. There's a big write-up on the credit ratings. Link itself has a big write-up on credit ratings, how they work, and that's a part of the Treasurer's wiki, the Treasurer's Handbook. So this I've made optional. Okay, ideally this entire material would have been covered as part of IFM. Okay, because it deals with capital raising. A lot of it deals with capital raising, risk management, but we didn't have the time to cover it. Okay, but you can cover it on your own. There's a lot of very good material. This is made by the Association of Corporate Treasurers. Okay, so if people are looking for a career in corporate treasury, that's one of the career options you have as a finance student. Okay, so this is a very useful book. In any case, you should read this book. It's very good learning. Okay, yes. Okay, I thought somebody was asking a question. Okay. Coming back to this points of, let's see if we can get, let's look at this. So the question that so if you have this question, very related to the question that obviously current is not properly spelled. Okay, the question that Goel was asking is, how do I figure out what real rate of return I should expect? As I said, the answer on an individual investor level, that's a subjective exercise. Okay, you have to figure out what you want for yourself. But there is a way in the developed capital markets to figure out what is the market's expectation of the TROR. Okay, what is the market's expectation of the TROR, which is the current market TROR, we can call it the market TROR. Okay, and the answer lies in the TIPS yield. TIPS yield. Okay, I think in TIPS yield. Do you know what TIPS stands for? There's too much activity going on. This business, one person is coming in and one person is going out. Although there's a waiting list. Okay, 1 minute. I'm trying to find out where TIPS is here, but let's just try to do TIPS. Okay, let's try and look for TIPS. Let's look at TIPS. So have you guys heard of TIPS? Oh my God, this TIPS is TIPS is very general. Okay, 1 minute. Let's now, what causes this we don't need. Yeah, okay, let's look at this. Where is the TIPS yield? Okay guys, let's look at this. I will give you this link into the, let's put this link here. So this is a relevant discussion as well. We should know what TIPS is. This is part of our learning on debt capital markets. Okay, and to figure out this answer to this question of here. All right. So this is too big. Now you can't read. Can you read at the on the last bench?
No, sir.
Chadda, can you read this? You can read? No, I'm asking Chadda. You can read?
Yes, sir. Yes.
Okay. So anyway, so you can read this on your own also later on. So let's get an answer to this question, which is a relevant question which Goyal has asked, is how do we figure out the target real rate of return? Individual investor level, it's subjective. You can always come up with your own figure where you disagree with the market's figure. But there is a way to know what the market is expecting right now on the TROR. Okay, so the answer in that lies in the TIPS. TIPS stands for TIPS is TIPS. It stands for Treasury Inflation Protected Securities. Okay, so we have this in India as well, but it's not that liquid. Like everything else in our bond market, it's not liquid. But the TIPS originated again in the US markets. Okay, so these are TIPS. Essentially what happens on these securities is the Treasury will adjust the principal to make sure that you get whatever has been the historical inflation over that period. So like over the last 1 year, okay, when the interest payment comes due, let's say, okay, so if there's been like 5% inflation in the last 1 year, the Treasury will adjust the payment in such a way that you will get a real rate of return. That 5% inflation will be made up to you. So normally what would happen in a plain vanilla bond, okay, if you have purchased the bond at par with a YTM of 5%, okay, that means you get a 5% coupon. All right. So in that period, let's say over the 1 year, you purchase, let's say, a multi-year bond, but it pays annual coupons, and it's a 5% coupon. Okay. So if there is, let's say, you at the end of the year you receive a 5% coupon on the bond that you're holding. Okay, are you following?
Yes, sir.
Okay, but suppose inflation in that year itself was 5%. That means your real rate of return is 0.
Yes.
Okay, so this is what happens in a normal bond, what we call a plain vanilla bond, okay, or a straight bond, okay. So, but if you bought a TIPS security, okay, because it's already a security, because S stands for security. So if you bought a TIPS, okay, a Treasury Inflation Protected Security, on that, if you got, let's say, whatever coupon you got, let's say you got a 3% coupon, okay, or you got, let's say, whatever, you got a 6% coupon, okay. On that, essentially, it will make sure that even if there has been 5% inflation over that year, okay, the Treasury will make sure that you get a yield of 6%. They will make sure that you are made, that 5% inflation is made up to you, so that inflation is protected. So if you've been assured, let's say, whatever coupon you've been assured, okay, 6% coupon, you will get a 6% real rate of return. Are you following?
Yes.
Yes, sir.
What people are not responding.
Yes, sir. Beyond 6% rate of return.
Yeah, whatever it could be anything. Whatever coupon you have initially invested at the beginning of the year, if you were sold a TIPS with a 3% return, okay, if you were sold a TIPS with a 3% return, and over the year there is a 5% inflation rate, your actual return, your real rate of return would have been negative. Okay, but in this case, if it's a TIPS, the Treasury will make it up to you to ensure that you realize a 3% real rate of return. This is clear.
Yes.
That's why it's called inflation protected securities. Okay, so now essentially what happens is the TIPS, I don't know if it's available here, but you can see it on the other. If you look at the FED, database, the FED database is a very good database. It's a US, it's the St. Louis FED, the St. Louis FED, which this is the bond yield. Okay, we can actually search 10-year. Let's look at this. So the point, are you following the discussion here so far?
Yes, sir.
Why we are discussing all this? Okay, because Goyal asked a question when we discussed that there is a This is a 10-year Treasury inflation index security, constant maturity. Let's look at this. Okay. So we were discussing the question of how do you know what the real rate of return is. Okay. One is that you can always form your own view on it. You can be and you can disagree with the market's view. But there is a way to, let's just look at 1 year to make sure that the data is current. What is the data here? Okay, 30th Jan is more or less current. Okay, so now we can look at even 5 years. All right, okay. So you can see now the current figure is around, this is February, is 0.82. Okay, all right. So essentially you can see the TIPS yield is 0.82. Okay, this is, so you can take this as a, how do you interpret the TIPS yield? The way to interpret the TIPS yield, so there is a market for TIPS in the US. It's an active market. This is what I mean by saying that the US capital markets are the deepest and most liquid capital markets in the world. Which is why every country that has any kind of surplus, including our reserves, we have about $400 billion of worth of reserves. A lot of big chunk of that would be invested in US Treasury bills and maybe some Treasury notes and stuff like that. Okay, some of it is invested in gold and all that. So where do countries invest their reserves? They all put it into US, I mean a big chunk of it goes into US capital markets because no other market offers that kind of liquidity and depth. Okay, so if you look at, so there is a market for TIPS, and the US TIPS market, the current yield is 0.82. Okay, which means that over 10 year, if you look at the yields on US Treasury securities, okay, over 10 years, the market as a whole, investors as a whole, are happy with a 0.82% real rate of return over 10 years. This is what it means. Okay, so this is the market clearing price essentially. If you see, I don't know if it will be able to show the max without distorting the end figures. Is that where we are? Yeah, 0.82. So you can see here that it kind of moves up and down. Okay, so this is essentially, this broadly it should be, there are some aberrations sometimes because in this 2008 recession it shot up initially because of some distortions. Okay, the market is still not that as liquid as it should be ideally, but in general it is a function of expectations of economic activity. Okay, if your market expects that economic growth will be quite strong, okay, then the TIPS yield will tend to inch up. Okay, because people will want to have because there are many more avenues for lending money, and then if they expect that people are going to make higher returns, okay, they will generally expect to receive higher real rates of return.
It would reduce.
No, normally the way we construct the theory, there are some aberrations as you can see here, but generally a rising TIPS yield is associated with market perceptions of a more a robust economic future. Which is why you notice here that after this Trump election, the TIPS yield has been slowly inching up. Okay, it was caught in a range for a long time after because the US economy has really taken off. Okay, because of the deregulation and tax cuts and all these aspects. Okay, so you can see that the TIPS yield is slowly inching higher. Okay, so this is basically what the TIPS yield is. Essentially, another way of and what you do is remember that. Look at this.
Sir, it will be inverse or directly correlated to the interest rate of the Fed Reserve.
You can't make a statement like that. It's a very strong statement because remember there's another factor in this. What is the other factor? So what is the TIPS yield? The TIPS yield is the LHS here. Are you following? The TIPS yield here is the LHS where my cursor is now. Here. Are you following? The TIPS yield is the real rate of return.
Yes, sir.
The TIPS yield is the real rate of return?
Yes.
Okay. So that means if and can I also observe the nominal rate? Look at this. What does it say? 2.4, 10-year nominal rate. Okay, these are actually the TIPS. These are actually the TIPS yields. Okay, because this is 10-year to 0.82. Okay. So we have to see the actual Treasury yield curve because this is obviously 10-year is 0.82 means these are actually the TIPS yields. Where is the actual yield if we try to select? Okay. it should be, actually we have another way of getting that, which is from the, yeah. So if you take, where are we, 2.4, sorry, this is 2.18. We have another way of getting that, which is okay, so 10-year rate is 273. Okay, so if you essentially want this, let's just plug in, they're not, maybe not be for the exact, I think that was for first Feb or something. Let's just ignore these 1 or 2 days differences, or let's just take it as 273 and 0.82. Okay, where are we here? All right, so what is happening is, essentially what this means is the real rate is, let's say, 0.82%. Okay, and then we have the nominal rate is let's make it 2.72 just to be wrong. Okay, are you following this?
Yes, sir.
Okay, so which means now can we figure out the expected inflation?
Yes, sir.
So you get a few pieces of information from all this market data.
Yes, sir.
Okay, so one is, you know, the nominal interest rate, and you also know from the theory that the nominal interest rate has to consist of the expected inflation, because anybody lending money is going to go through this calculation.
Yes, sir.
If I have to lend money to anyone, I'm going to first go through this. I'm going to first think about what kind of real rate of return do I want to realize over this period. Okay, and then I'm going to ask myself, okay, how much inflation am I expecting over this period? Okay, so if I'm expecting a 4% real rate of return and I expect 3% inflation, I'm going to charge the guy 7%, so that I can realize my 4% real rate of return even after losing 3% on inflation. Is everyone clear? This is the logic. So therefore the nominal rate is equal to real rate plus expected inflation. Okay, or in other words, the real rate is equal to nominal rate minus expected inflation.
Yes, sir.
Okay, or you can also have nominal rate minus real rate is equal to
Expected inflation.
expected inflation. Okay, so this is the last part that we can write. Okay,
So that's all for today, sir. We will
One
not able to
minute.
begin.
no, 1 minute guys, what was the contract?
Contract is the species of the agreement.
Who said that?
Tushar.
you haven't. You have also forgotten your contract law. So that is definitely not acceptable. Nominal rate.
Yes, sir.
1 minute. So the class started at 3:30. So the class will end at 5.
Yes, sir.
1 minute. 1 minute. 1 minute. Everybody is half asleep anyway from the beginning of the class, so it makes no difference. 1 minute. Makes no difference. Okay. Alright, quiet please. Let's make sure we cover all these concepts. So are you following this logic? What? So the nominal rate minus the real rate. What did we find? The nominal rate is 2.72. Okay. The nominal rate is 2.72. Then the real rate is
1.90.
no 0.82.
Expected inflation.
Yeah. So this is 0.82. The real rate. Are you following the logic here? The TIPS yield is the real rate, because the TIPS yield will be protected. Okay. So if you buy a bond at TIPS with a 2% coupon, the treasury will make sure that you will realize a real return of 2%. Okay. Whatever is the inflation will be made up to you. Okay. So therefore the TIPS yield is the real yield. Okay. And because of these relationships that we know, the nominal yield can also be seen as we saw here, 2.72. There's another way to see the nominal yield, and that is to just go to your chart and type TNX in this particular piece of software. TNX is the ticker for the interest rate. You can see here it is, why is it 2? Okay, So it is actually 2.72. Okay, this is the index actually. This is how it's constructed. So you can see it's 2.72, which is what we have here. All right. So the nominal 10-year rate is 2.72. The real rate of the TIPS yield for 10 years is 0.82. So we can figure out the difference between the two is what we say is what the market is expecting in terms of inflation over the next 10-year period in the US. Are you following?
Yes.
This is an important concept to be aware of, that this is what is called the market's expected, I mean this is how you figure out the market's inflation expectations. So when central banks make policy, okay, when central banks are making policy decisions, one of the important things they look at is what is the market's inflation expectation. And one of the goals of monetary policy in most of these modern economies is trying to make sure that the inflation expectations of the market are well anchored. Have you heard this expression?
Yes.
In policy debates, that inflation expectations have to be well anchored. So the market, therefore the central bank is always looking at market expectations and market's inflation expectations and trying to ensure that they remain well anchored. Okay. So that covers this point about TIPS. We've covered all these aspects. All right. Okay. Now let's go on to this. 1 minute. No. Why are you going back on your promise? You said that the class would be. You were.
So many minutes.
1 minute. No. 1 minute.
From the last 10, 6, 7 minutes from this.
Now we look at credit spreads. One sec. Let's look at credit spreads. Okay. So you have the idea about high grade corporate bonds, investment grade corporate bonds, and junk bonds. Remember we discussed when we looked at credit ratings, highly rated corporate bonds and lower rated corporate bonds.
The crediting of AAA.
Yeah. So if you look at, so what I've said is there are two important points to be aware of. So let's go into. Okay. Now I think what happened? Why are two people going? Okay. 1 minute. Now because of this, now I'll stop going out. Now if whoever goes out will lose 2%. No more going out because you guys are abusing the privilege. Today you can go, but from tomorrow, from the next class, no more going out. There will be like a cat session, okay? If you can sit through, how long is the cat? 3 hours. Okay, so if you can sit through the cat without a break for 3 hours, no, nothing, no going out because you've abused the privilege. You can go out, but every time you go out, you lose 2%. Your team will lose 2%. Simple as that. Because I'm fed up of this attitude. You are not concentrating in the class, so no more going out. You have abused the privilege. 1 sec. No. You have abused the privilege.
Not every time.
No.
Yes.
This is the rule. If you don't like it, you can go and complain to DG sir.
Okay.
Because you have abused the privilege that is given to you.
Yes.
Okay, so you have AAA ratings and you have AAA bond ratings and you have lower rank bond ratings. If you look at this chart here, what we are trying to establish is two facts. Okay, so let's look at the this is the low grade bond rating. Okay, let's call it like whatever we want to. Okay, let's look at, let's say triple B. Let's look at it at triple B category. Okay, still above junk rating, but much lower than the AAA rating. Okay, let's look at what we are looking at this chart. Two things to be aware of. What are we looking at? What kind of variable are we looking at here? Difference in percentage points, corporate bond yield minus US Treasury bond yield. So what is the variable that is being plotted here?
Sir, spread over na? Spread.
Credit spread. Okay, so this is a chart of credit spreads. So one of the things you can see here is that there are two things we want to focus on when we are looking at this chart. These have been mentioned over here on top. So I'm just gonna so that you can see the chart. Okay, two things to notice here is that obviously common sense, which spread is going to be higher? The triple B spread or the AAA spread?
Sir, triple B.
Triple B spread is higher, right? the triple B, the absolute size of the triple B spread has to be more.
Yes.
Okay, because the net yield on the triple B rate bond has to be more, and the sovereign benchmark is the same. So the triple B, so one is that I've written it the other way on top. I've written that the triple A spread is always lower than the triple B spread, or any higher rating spread will be lower than the lower rating spread. That's one. The second thing, do you notice from this chart? Do you notice that it's also less volatile?
Yes.
Can you see that?
Yes, sir.
That the movement is much more dramatic in the lower ranked triple B. Let's call it the triple B spread. They've just called it low grade, but let's call it triple B. So if you look at a triple B spread, the volatility is much more.
High.
It varies much more. Okay, because and so the other thing to note also is that remember we discussed that the hierarchy of claims
Yes, sir.
when we looked at that balance sheet.
Yes.
Okay, so you have like senior debt, subordinated debt, and then what comes below? What is the lowest rank claim? Equity. Okay, so now look at one more thing. Look at how it makes sense, how it ties in, how the volatility ties in. Okay, one you see that is the volatility of the triple B spread is much higher than the volatility of the triple A spread. Okay, and then if you look at the volatility of the stock market, okay, if you look at the volatility of the spread is little hard to get data on that. Actual data, we can compute the volatility from if we have the actual data. But if you look at the equity volatility, essentially you will find that equity volatility is much higher. Okay, in this period, equity volatility was something around 40% or so. Okay, this is the VIX. Have you guys heard of the VIX?
Yes, sir.
Okay, the VIX is an index of equity volatility. This is actually the current level of the VIX. This big jump in equity volatility you can see here. This is around 1 month volatility for the S&P 500. Okay, this is the 1 month volatility index for options on the S&P 500. This might be actually based on the S&P 100. Okay, it's an equity index volatility. So this is 90% it went to in the 2008 credit crisis. Okay, right now it's trading at 15.5% roughly. Okay, so this essentially you'll find, the point I'm trying to emphasize is, the reason I've given you the link to the equity volatility is that you can think of this when you're thinking about the volatility of credit spreads. You see that the triple B spread is much more volatile than the triple A spread.
Yes.
And if you can push yourself further down the hierarchy of claims and think about the equity spread as well, because this is just a continuum, okay, you will find that actually if you calculate the volatility here, triple B spread, triple A spread, and the equity volatility, you will find that equity volatility is even higher than this.
Yes.
Okay, because it is further down on the hierarchy of claims. Okay, so you have to understand when you're looking at the volatility of credit spreads and the volatility of equities, you have to understand that debt and equity is just like a continuum actually. Okay, so therefore the volatility is increasing because depending on how low they are on the hierarchy of claims. All right, so one last point about this particular topic, which is the importance of junk bond markets. Okay, so these terms you have to be aware of. High yield. So typically when you look at discussions on the Bloomberg, on Bloomberg TV, you will find that, or even if you look at tickers, you'll find HY as a ticker, so that means high yield. Okay, which is junk bonds essentially. All right, which means essentially below this thing, below this, and this is the non-investment grade category. This is junk. Okay, so if you look at this, you will see the other ticker you might notice is IG. IG stands for investment grade. Okay, which means essentially again the other side of this, the upper half of this, investment grade. These are all the investment grade ratings. Okay, so if you guys, any of you going for the Moody's, if you go for a Moody's Analytics interview, normally you don't have to memorize the stuff. Okay, but if you're going for Moody's Analytics, I think it makes sense to have memorized the Moody's ratings. Okay, so I mean I don't think it's really very important, but it can't hurt. Okay, so in general you just should know where to find this so that you can look up the ratings. Okay, so the point is high yield versus investment grade. There is a contrast that we make between these two categories. Okay, so what you have to understand is the importance of junk bond markets. If you remember, Tanuj was mentioning several classes ago, I think in the previous course, he asked this question about how do you sell the securities of poorly rated companies, or you said companies which are not like Alibaba, which are not so well known. How do you sell their securities? Okay, not so well known, right? How do you sell them? Sorry?
Very low credit rating.
Low credit ratings. Okay, how do you sell their securities?
High interest rate.
Higher interest rates essentially. Okay, so obviously part of the answer is that is the skill of the distribution team. That is the skill of the salesman on the distribution team, how well you market that product. Second is that here you have to understand that essentially, have you guys heard of Michael Milken? You haven't heard of Michael Milken? Michael Milken is the guy who essentially invented the junk bond market in the US. Okay, so if you read this movie Barbarians at the Gate, there may be some references to junk bonds. So the entire LBO boom which happened in the US in the 80s, okay, that was to a great extent financed by the issuance of junk bonds. So understand how Michael Milken made the case for junk bonds and how he literally developed the market in junk bonds. So he had this investment bank called Drexel Burnham Lambert. Have you heard of them? Drexel. Okay, so they went bankrupt essentially, but at that time, eventually these guys were accused of insider trading and all that. But Drexel, what they did was they went and see how a market is developed. What Michael Milken did was he did some research on junk bonds, and he found that essentially what the market does, okay, kind of what Oaktree is doing. He found that essentially what the market does is the market oversells. Okay, Tanuj will also lose some points because you were. So Tanuj will go to -4. Okay, so what he found was that the market tends to always underprice these securities. They tend to oversell these junk bonds. So essentially what happens is that what he was saying is that he did some research and made the case that if you carefully select a portfolio, if you carefully construct a portfolio of junk bonds, okay, over the long term, your default rate is going to be much lower than what the market was expecting. So the market, because the market always panics, remember the market is not rational. So the market panics and this is one of the reasons why value investing sometimes works, depending on when you went into the market. Because the market tends to panic. Okay, so like look at this. If you look at this, for instance, when you go back to the SPY, okay, now if you see here what has happened here, if you see the sharp sell-off here in the US stock market, so there was a lot of panic about trade talks and this, that, and all kinds of stuff, and the market sold off into the year end, okay? But you see how sharp this rally is. So you could argue that the market has actually, at this point, the market had panicked and sold off stocks too much. The market panicked and now the market has realized. So this is how the market works. The market moves in, goes through swings of greed and fear, okay, and panic and euphoria. This is why I said markets are not rational, okay. This is what happens. So what he showed was that if you carefully built up a portfolio of junk bonds, over the long term, the default rate on those bonds will be much less than what the market was expecting. So that eventually you will make money on that portfolio. So by using this kind of research, Michael Milken was able to sell junk bonds as an investment proposition to fixed income investors, to bond investors. And that's how, remember this, what is Michael Milken doing? He's acting as he's functioning as what? Distribution or origination? Distribution. He's functioning like a distribution guy because he's going to investors and he's making the case for junk bonds. Making the case for buying junk bonds in their portfolio, putting junk bonds in their portfolio. Are you following?
Yes.
This is what a distribution guy does.
Yes, sir. Yes.
He goes to investors and tries to sell debt securities to them. So this is what he was doing. On the one hand, he was functioning like a distribution guy, going to investors, making the case for junk bonds. And on the other hand, he was encouraging issuers to issue junk bonds. Are you following?
Yes, sir.
So both sides, and this is how he essentially developed the market but obviously the investor side is more important. Because companies always need money, issuers always need money. You need to cover the investor side first. Okay, so is this clear?
Yes, sir.
Okay, so we can give you a 4-minute break, I think.